Hey everyone, welcome back to Corporate Decoder, the place where we break down the big business news and the documents that back it up. And today, we've got a real doozy. KFORCE Inc. is shedding some serious light on their business in their latest annual report, and let's just say not everything is sunshine and rainbows, so grab your popcorn. Because we are diving deep into the numbers and the risks. Alright, let's jump right into the heart of this report, which is how KFORCE is performing financially, and things have definitely seen better days. For the year ended the 31st of December 2025, their total revenue took a dip. It went down by 5.4%, bringing in about $1.33 billion compared to $1.41 billion in 2024. That might not sound huge, but it means they are bringing in less money than before. They've got two main segments, technology and finance and accounting, or FAR technology, is their biggest slice of the pie, making up about 93% of their business. But even that segment saw its revenue drop by nearly 5%. The FAR business took an even bigger hit, with revenue falling by over 12%. Now, looking closer at how they make money, it is split between flex revenue and direct hire revenue. Flex revenue, where they provide temporary staff or solutions, makes up the vast majority of their business, about 98%. But even this core area saw a 5.3% drop. Direct hire revenue, where they place people in permanent jobs, took a nosedive of over 11%. This tells us that clients are spending less on both short-term and long-term staffing needs, which often reflects a general nervousness in the economy. Let's talk about profitability, because that is what really matters. Their gross profit margin, which is what is left after paying for the direct costs of their services, went down slightly to 27.2% from 27.4% last year. This might seem small, but in the world of business, even tiny drops can mean a lot of money. They attribute this to a change in the mix of their business, with less of the higher margin direct hire revenue coming in. The flex gross profit margin also decreased, showing that the core of their business is facing margin pressure. Now, when revenues go down, companies often try to cut expenses, but KFORCE's selling general and administrative expenses, or SG&A, actually went up as a percentage of their revenue. It climbed to 23% from 22% last year. This suggests that even though they are bringing in less money, their overhead costs are taking up a bigger chunk of it. They mention making investments in strategic priorities like their Workday implementation and AI capabilities, which are important for the future. But right now, it is leading to this expense increase relative to their income. And what does all of this mean for the bottom line? Well, net income, the actual profit after all expenses and taxes, took a significant hit. It dropped by almost 31% to $34.8 million. This also means their diluted earnings per S-hair decreased to $1.96 from $2.68 last year. That is a noticeable drop for shareholders. Now, let's look at cash flow. Cash provided by operating activities, which is essentially the cash generated from their day-to-day business, was $61.6 million in 2025. That is down from $86.9 million in 2024. They explain this is mainly due to lower profits, higher costs for implementing new technology like Workday, and paying off some deferred taxes. While they still generated positive cash flow, the decrease is a sign that the business is under pressure. Looking at the changes year over year, KFORCE is facing a challenging macroeconomic environment. They mention ongoing uncertainties and the early stages of AI adoption as reasons for why companies are being cautious with their technology spending. This is a big deal because technology is their bread and butter. The tech staffing market is projected to have modest growth, but KFORCE's own tech revenue saw a decline. It is also worth noting how their income before taxes has changed. In 2025, it was $46.9 million, which is a drop from $67.6 million in 2024. This is a clear indicator that the business is less profitable overall. The effective tax rate hovered around 25 to 28%, which is pretty standard, but the lower income before taxes means they are paying less in taxes, simply because there is less profit to tax. Now, KFORCE knows there are risks involved in their business, and they lay them all out. One big area is cybersecurity and technology. They are constantly at risk of cyber attacks and data breaches, which could severely damage their reputation and operations. They also depend heavily on their information systems, and any disruption there can bring things to a halt. And of course, with the rise of AI, they are acknowledging the potential operational challenges, legal liabilities, and privacy concerns that come with it. It is clear they are aware of the technological landscape and its inherent dangers. Another significant risk they highlight is around immigration. A big part of their technology business relies on foreign nationals working in the US on visas, particularly the H-1B visa. Any changes or restrictions to these visa programs could really hurt their ability to find the skilled talent they need, which is a major threat to their business model. Let's talk about shareholder value. KFORCE returned $76 million to shareholders in 2025 through stock repurchases and dividends. That is a good chunk of change. and they do say they are committed to returning capital to shareholders. For the year ended the 31st of December 2025, their market value for non-affiliates was over $631 million. However, with profits down, it will be interesting to see if they can maintain this level of shareholder return in the future. So what is the overall picture here? KFORCE is navigating a really tough economic climate. Their revenue is down and their profits have taken a hit. They are making strategic investments, which is good for the long term, but in the short term, it is impacting their profitability. The reliance on technology talent in a fluctuating economy, coupled with the risks associated with immigration and cybersecurity, presents a complex operating environment. They are trying to maintain shareholder value through buybacks and dividends, but declining profits will always make that a challenge. Looking at KFORCE, they are in a competitive industry. The demand for tech and finance talent is always there, but companies are being more selective with their spending. KFORCE's strategy of focusing on technology and solutions is smart, but they need to see an improvement in the broader economic conditions to really bounce back. The increase in SG&A as a percentage of revenue is a concern, as it suggests they might be struggling to control costs in line with revenue. However, their strong cash generation from operations, even though it is down, and their access to credit are positive signs for liquidity. To wrap it up, KFORCE is facing headwinds, while they are focused on strategic growth and shareholder returns. The current economic climate and industry shifts are clearly impacting their financial performance. They need to carefully manage their expenses while continuing to invest in future growth areas like AI. So, what is my take on KFORCE right now? They are a resilient company that has been through economic cycles before, but this one appears particularly challenging their technology. First strategy is sound, but the immediate future looks tough with revenue and profit declines. They are managing their cash well, but the rising expense ratio is a red flag. The company appears to be in a defensive mode trying to weather the storm. But sustained profitability will require a stronger economic rebound and a successful execution of their strategic investments. What do you all think about KFORCE's performance and their outlook? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the financial world. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.